Right. Now, how about let's take a look at the second financial statement, which is what we call the balance sheet. Okay, balance sheet. Now, so balance sheet is a snapshot of the financial condition of the firm at a particular moment. Right? So of course, we can do balance sheet at any time of the year or any time of the period that we wish. But again, in order to write up a balance sheet, it takes time. Okay, it takes time. All right, because what are we actually recording? Rather than the daily operation, okay, on the cash position or the sales activity of the firm, we focus on the firm's fundamental financial condition, assets and liabilities. Okay, what are the assets? What are the items that I have? Okay, and then how about the liability? How much do I owe? Okay, what are my debt? And then we have shareholders' equity or stockholders' equity. Okay, because in a firm you must have some major shareholders. Okay, either you're a listed company or not a listed company. Okay, if you're not a listed company, it simply means that you have not considered going public yet, but you still have some major shareholders who are responsible for providing the firm with important and substantial capital funding to help you to establish the firm. Okay, so in that case, the shareholder equity is extremely important. It would be determinant on whether the firm can continue for operation or whether the firm can survive through a financial crisis, okay, in terms of declining economy, all right? So shareholders or stockholder equity, we have the difference in assets and liabilities, also the net worth of the firm. Right, so here, the example from TSMC, we have consolidated balance sheet for TSMC. Again, we're taking the most recent statement that we have. It will be as of December 31st, 2015. And then again, we have the amount, and then we have the percentages, okay? So in terms of assets, okay, we can define them as detailed as possible because this is to show how the firm is actually categorizing the different accounting items, okay, so that they could have a very good management and a good management of the different assets that they have in the firm. Okay, so here, current assets. We have cash and cash equivalents. That will be 34% of the current assets, which is good, okay, and important. Financial assets at fair value through profit or loss. Available for sale financial assets. Now, what are the financial assets? Okay, that will be stocks, mutual funds, maybe some futures, options. Okay, those are what we call financial assets, or maybe corporate bonds. Okay, any types of financial assets that the firm is also investing in. Okay, for a manufacturing firm like TSMC. Okay, they will also be interested in investing in other firms, right? And then we have held to maturity financial assets. Okay, so that we will be, we will guess that it will be bonds. Okay, bonds. Okay, hedged derivative financial assets. Okay, receivables from related parties. Other receivables from related parties. This will be the sales transaction. Okay, how they're dealing with the partners or with their clients. Okay, for the receivables. Okay, for the payments of the merchandise, right? And then we have inventories, and we have non-current assets held for sale, and other financial assets and other current assets. Okay, so here we can take a look. Is that we know that TSMC is actually quite good in financial asset management. Okay, so they must have a very strong financial management team or financial department to help them not only in the aspect of the manufacturing, okay, for the inventory and also for the receivables, but besides that, they also have finance team to help them to do all the financial decisions in the investment markets. Now, how about non-current assets? Okay, we have available for sale financial assets. Okay, this will be held in the long term. Usually, we define current assets within the period of 1 year. Okay, that will be what we define current asset. Okay, and any asset longer than 1 year, between 3 to 5 or maybe up to 10 years, we call it as non-current assets. Right? And then held to maturity financial assets. Financial assets carry at cost. investments accounted for using equity methods, property, plant, and equipment. Okay, noticing that here, plant, equity, equipment, and property, it would take up to 52% of the non-current assets. Okay, and this, what can we imagine this to be? It would be the production sites, okay, the factory locations, okay, where TSMC is producing their goods, okay, producing the little chips, okay, all right. So it will take up to 52% non-current financial assets, and they probably don't have the intention to sell, okay, but it does have an increase in cash value, okay. And then we have intangible assets, deferred income assets, refundable deposits, and other non-current assets. All right. So here in this part for TSMC, they only calculated the percentage for property, plant, and equipment at 52%, and they also calculated for the investments accounted for using equity methods. Of course, there's some footnotes. Okay, below that will be note 5. And also note 15, okay, that will be listed in the annual reports, okay, right, and then we have total non-current asset will take up to 55%, okay, so in total, the asset is, by taking non-current asset plus the current asset, 45% plus 55%, that will equal to 100%, okay, so in a balance sheet, it's very important that the asset side and the liability plus the shareholder equity, they will add up to 100%. That's why it's a balance sheet. Okay. However, how much the asset I have must equal to the liabilities and the shareholder equity that I have. Right. So let's take a look further on the liability and equity side. Okay, that will be on the right-hand side. We have current liabilities that will include short-term loans. Okay, at 2%. And we have financial liabilities at fair value through profit or loss. We have hedging derivative financial liabilities. We have accounts payable, okay? And we have payables to related parties, salary and bonus payable. And then we also have accrued profit sharing bonus to employees and compensation to directors and supervisors, payables to contractors and equipment suppliers, income tax payable, provisions, liabilities directly associated with non-current asset held for sale. We have long-term liabilities, current portion, okay, and then we have accrued expenses and other current liabilities, okay. Now noticing in the current liabilities, it will take up to 13% in total, okay, of the liabilities, okay. And then we notice that it's a very detailed segmentation of the different liability items, okay? Liability to contractor, liability to employees, to bonuses, and also accounts payable, okay, right? But the biggest chunk will be income tax, payable to contractors and equipment suppliers, and short-term loans, okay? Now, we also have non-current liabilities, okay? We have hedging derivatives financial liabilities. We have bonds payable, right? So this is what we actually, expected. TSMC is actually, participating actively in the bond market, all right? So that's why they have a duration, okay? For the assets that will be, maturing, and also they have bonds payable, okay? Like what we have expected at 12%. And then we have long-term bank loans, deferred income tax liabilities, obligations under finance leases, and we have net defined benefit liability, guarantee deposits, and others, okay? So in total, the non-current liability is also 13%. So here, at this part, the total liability is 26%, okay, 26%. Now, compared to 45% of the current asset and 55% of the non-current asset, the liability is actually well at hand, okay? TSMC can afford to manage these liabilities from the asset position that they have. And furthermore, we have equity, okay, equity attributable to shareholders of the parent, okay, because TSMC is a big group, so they have the parent company and they have the subsidiary companies. So here, to the parent, we have capital stock at 16%, capital surplus at 3%, retained earnings, okay, we have appropriate as legal capital reserve at 11%, appropriated as special capital reserve and unappropriated earnings and others. And so in total, we have equity attributable to shareholder of the parent is 74%, okay? And the non-controlling interest, total equity at 74%. So in total, liability plus the shareholder equity, we have again 100%. So in a balance sheet, the asset should equal to liability plus equity, shareholder equity, okay? Now, for the capital of the stock, the retained earnings, we'll discuss later how the firm is using the extra income or the retained earning to pay for dividends and also to allocate the fund for other investment projects. And then in that case, the firm can continue for future investment and they can generate more sales income.